Okay, welcome everyone to our live event today. A lot has certainly happened since our last webinar on April 10th, and so Grayson and I wanted to update everyone on our thoughts as to what's going on in the market as we get into the summer months here. I'd also like to acknowledge the work Caroline Crisp on our team did to put a lot of this data together, and of course, Kathy Schricker always does a wonderful job getting the word out to you when we have important updates like this that we want to share. So often in conversations or seminars like this, we attempt to share several items that we think you need to understand to be a successful investor. This time will certainly be no different. But lately, I've been reminded that your belief system is a lot more important than our belief system, because your money will ultimately follow your beliefs, not ours. I saw a great quote last week from a 20th century author and Harvard graduate named John Dos Passos. He said, "In times of change and danger, when there is a quicksand of fear under men's reasoning, a sense of continuity with generations gone before can stretch like a lifeline across the scary present and get us past that idiot delusion of the exceptional now that blocks good thinking." You might remember the detail we went into back in April in our last webinar about the Spanish flu of 1917 and 1918, how the markets reacted back then, and the fact that our country has been through something much worse than what we're going through right now, as crazy as that may sound. Well, our country is certainly trying to get a handle on COVID-19, but the market has gone up a ton. And it begs the question, where do we go from here? As you can see from the chart on the top, the stock market dropped about 35% from late February to late March. But since then, it's also up about 35%. This is actually very similar to what we saw over 100 years ago during the Spanish flu crisis. There was a hard bottom, a sharp partial recovery, and then it took several more months for a full recovery as our country tried to get a handle on the crisis. Now, none of us were obviously around back then, but as I analyzed the data from 1917 and 1918, it just feels really similar to what's going on today. One of the most frequent questions at the moment is, why has the market gone up so quickly? At one point, it was even up over 40% from the February 19th low. Let's take a look at the unemployment figures and how they increased as the market climbed significantly. You can see in the bottom right chart here, every day the financial news media was talking about how we've never seen unemployment figures like this in our country. We're setting records in unemployment. And yet it was as if the stock market didn't care. It just kept going up. And, you know, this is what kind of happens when you have to sell news. You know, the market going up isn't bad news. That's good news. But total employment going up is bad news. So you can see with the orange bars, total unemployment going up, how can the market go up at the same time? I mean, all I heard back in March was unemployment's going to get worse. I don't see how the market can continue to climb. Well, let's look at this another way. This chart shows how weekly unemployment claims have actually decreased over that same time frame. So as total unemployment went up, weekly initial unemployment claims went down. So while many investors typically look for good news to help them feel more secure about their portfolio, the overall market does not. It just wants news that's not as bad as the day before. That's where the old saying comes from, the market climbs a wall of worry. Now, the market is always a leading indicator, not a lagging indicator. It can go up when there's less bad news than the day before. It doesn't necessarily need good news to improve. I'll promise you this, the market is already 6 to 9 months ahead of this thing and primarily concerned with what might happen early next year. Here's a very unscientific sample of the headlines I pulled from my own iPhone one day in early June. I just wanted to see how a normal retail investor might feel after reading these headlines. I concluded the answer is not very good. The fear that can come up is almost intoxicating and paralyzing at the same time. I mean, just look at these headlines. Over to the left, why the Dow rally won't stop now based on recent market history. And then just to the right, Wall Street hits brakes on rally. Dow plunges more than 350 points. I mean, is the Dow rallying or is it not? Those are two headlines right next to each other. That makes no sense. Over to the right, Jim Cramer at CNBC, who's certainly not known. He's a well-known person, but not known for his expert stock picking if you look at his performance. He says, this is the most overbought market in history. Well, the market's gone up a lot since he even said that. Let's look at some more. Over to the left. One of the most successful investors ever is called an idiot by somebody who is day trading. I mean, I'm not a day trader. I know two people that have tried day trading, and neither one of them do it anymore because they both lost a bunch of money. Stocks pull back after a recent rally. The U.S. economy is now in a recession. What to watch at this week's Fed meeting. I mean, this is, let's see, March, April, May, June. That headline is 4 months after the recession actually started. So I just keep asking myself, guys, how valuable is this news? Over to the right, stock market live Monday, S&P goes positive for the year. Dow up 450, NASDAQ new highs. And then just below it, stocks sink as investors take profits from coronavirus reopening rally. I mean, this stuff will just make your head spin. Warren Buffett said those who invest only when commentators are upbeat end up paying a heavy price for meaningless reassurance. I love what Dave Ramsey says. If you want to be rich, then do what rich people do. I don't think any of us are as rich as Warren Buffett. And by overall standards in this country and the world, most of us probably are rich. So I'd say if we want to stay rich, let's do what really rich people do. History will always be more important than headlines. Honestly, back in April, this was a little tough to call. We certainly had it on our minds, but when we were in really the toughest days in weeks of the crisis, from at least a financial standpoint, this was kind of a tough point to get across. But most of you can probably remember how often Grayson and I have been talking to you in review meetings about 1987. Let me grab my cursor here. So what this does is, this is 1987. The red dot shows on this chart how much the market went down in a given year, okay? So the market went down 34% in 1987. But at the same time, this gray bar that has a 2 above it, that's the market's return for the entire year. So in 1987, the market was up 2%, and yet it was down 34% during that year. So when the market went down 34%, it had to recover pretty quickly to be up 2% for the whole year. Let's think about this year. Could we actually have a positive stock market this year? You know, we're really not that far away. Maybe 4 to 5%. So I'd say it doesn't really matter as it relates to your long-term goals, whether the market is positive or negative this year. But it's really interesting to see all the ways this market repeats itself over and over again throughout history. Because so far, this is very, very similar to 1987. Yet the reasons the market went down in 1987 and the reasons the market went down this year are totally different. But it's not the news that always stays the same. It's the market's reaction to the news that's often so similar. Tony Robbins has this great quote about fear, and he's got this really good example I want to try to show. I can be fearful and do it anyway. I don't have to get rid of the fear. I just have to dance with it. I think the problem oftentimes with investors is that we know we should be afraid of something. We just don't know what. And I think that's true. I think fear is an appropriate piece on some level of any proper financial plan. But when we're bombarded with scary headlines, it just messes us up even more. And then we end up getting in our own way as investors. Let's see if we can watch this video here and it'll get our point across.
Right? Now I got a couple choices. Hang on tight. I can try and fight him. Now I'm bigger than he is, but on this angle, could he break my wrist? Yes or no? Absolutely good, please don't. Hang nice and tight though. If I fight him, we got a battle and I'm not gonna make much progress. The other approach is pretend I'm not afraid. Is that gonna work? No. So fighting doesn't work, pretending it's not there doesn't work. Well, maybe we try a different approach. What if instead of fighting it, we connect to it just for a moment? So I want you, Anish, take me where you want, hand my wrist, and take me where you want to go. Take me someplace. Take me strong, take me strong, come on. That's it, good, take me someplace. Come on, take me someplace. Come on, take me someplace. Come on, take me someplace. That's it, perfect. Yes, you. And he slowed down at the end. Why? Because when he grabbed me, wherever he goes, if I don't resist and I just walk with him, I'm seeing where he's going, go at the same tempo, there's no pull. There's no fight. He wears out. I'm free. That's what you do with your fear. You dance with your fear. You don't pretend it's not there. You don't fight it. You use it. Stress uses you or you use stress. Fear uses you or you use fear. Dancing with it. Now watch this. Come over here so they can see it. Grab my wrist again with both hands real tight. Real tight. Don't let it go. And if he does this, watch. But don't let me go. I try to fight to break the wrist. Ignore, I go nowhere. But watch this. What if when he attacks me, fear attacks, hang on, I align with him and I come along beside him and I go, I see that, and let's do this instead. The more, hang on tight, the more he hangs on, nice and tight. The more he hangs on, the more control I have if I align with him. See, I'm looking at his point of view. You're right, I'm a little fearful. And let's try this. In martial arts, this is Aikido. Hang on tight. In Aikido, conflict, you don't fear, you align with it. Oh yeah, I see what you mean. Let's do this. And you can take the person you want to go without even harming them. That's what you want to do with your fear. Give him a big hand. Thank you so much.
I love that video because I think fear is such a big part of all of our lives. And, you know, Tony Robbins says that if we just knew what we wanted out in life or out of life, we would just go get it. And it would be real simple and real easy. But we have conflicting emotions, conflicting desires in the financial and investment world. We want growth, but we also want security. I mean, two of the major desires that humans have, one is certainty and one is uncertainty. We are complex creatures. And so our team, we try to figure out ways to help you dance with the fear and not let it take over. Some of you have seen this slide so many times, I'm almost embarrassed to show it to you again, but it's so important. If you want to know as an investor what to be fearful of, it's not the bad years in the market. It's the bad decades. So let's walk through this just briefly. This is the market since 1926. Real return equals total return minus inflation, okay? So when we say the market's had a 6.4% trend, that's after inflation. You add 3 to 4% for inflation to 6.4, and you're going to get about a 10% total return on the stock market, the S&P 500, going back about 100 years. So we don't worry about the bad years, because here's 1987. Look how quickly it recovered. That's a 1/3 drop like what we've had this year, but it recovered so quick. But that's because we were inside of a long-term bull market. Well, what happens right before a long-term bull market? A long-term bear market. What happens right after a long-term bull market? This one lasted about 25 years, which, by the way, so did that one. But after a long-term bull market, you get a long-term bear. These are typically will last about a decade. So, and then what happens after a bad decade? You get a couple of good decades. So we don't think we're on schedule for a bad decade again anytime soon, but it's our job to be on the lookout and help you be prepared for when they do come. So our opinion is that the effect of this crisis on the markets really won't be too bad, simply because we believe we're still in a long-term bull market. So this will be, by definition, just like 1987, this is a short-term bear market inside of a long-term bull market. And that's what you need to know. We don't want to be afraid of the bad years, but we do want to be very, very careful about the bad decades. We don't want to stick our heads in the sand and pretend the market is always perfect. We also don't want to freak out and abandon it altogether. We just have to understand when we might be rewarded as investors and when we might not be. This is how you align yourself with fear and use it to your advantage. Okay, Grayson?
Thanks, Michael. I want to go back, guys, and draw your attention again to one of the things that Michael mentioned, the difference between history and headlines. So let's look at this quote. It's another quote from Howard Marks, who is a very prominent investor today. And you'll see that we can split this quote into a couple of different parts. I'm going to read it to you here in just a second. The confluence of 4 factors: the pandemic, the shuttered economy, the oil price collapse, and the federal response to the crisis makes forecasting functionally impossible right now. So similar to our thought process on the last slide, my question is, how much forecasting do we really need in our financial plan? In other words, do we really even need the market to be positive this year? And if not, will we still have financial peace? Let's dissect this quote a little bit further. Again, let's split it up into history and headlines, okay? The history part is the second half of the quote: makes forecasting functionally impossible right now. But the headlines are what cause the forecasting to be functionally impossible. Okay, the headlines are always going to be there, yet as we become great students of history, we'll notice, like Michael mentioned in that previous slide, in that previous chart, that the market has tended to repeat itself, and we have, again, on a short-term scale, not total certainty of what the market's going to do, but as we continue on and look through more macro data, we have a very good idea of where the market's going to end up, and that gives us a lot of certainty. So let's go to the next slide and look at a little bit more history and the way that we can systematically and really functionally prepare your portfolios for what we would consider to be a worst case type of market scenario. And in the US economy, let's look no further than the worst period in stock market history, the Great Depression. As you can see from this chart, it took 4 years for an investor with $10,000 to lose 80% of his or her money and have only $2,000 left in 1932. Yet, 4 years later, that same investor would be fully recovered of that $8,000. And now, in real dollars, in 2020, that $10,000 would ultimately be over $40 million in today's dollars. So why do we doubt the market again? Can someone remind me about that? Yet the point of this slide is not the upside, it's the downside. It's the 8-year period where we can't sell your investments, the stock portion of your investments, if you're ever going to get to that $40 million or even $1 million. An 8-year period, investors need to understand the difference between short-term bear markets, which are the bad markets, and the long-term bear markets, which are the long-term bad markets. So from a just kind of a normal real world perspective, how do we prepare your portfolio to be able to withstand that 8-year downturn in the market within your equity portion of your portfolio? So if we look at a scenario for retired investors, we have to be prepared for a Great Depression-like scenario, or what we would consider to be a rainy day fund within your portfolio. Well, fixed income and cash can serve that purpose. And if we look at this pie chart here, in just a standard 60% stock, 40% bond, or fixed income portfolio, we feel like that would prepare you for a Great Depression type scenario if we withdraw only 4% a year. So historically, stocks have earned 10% and really serve as that long-term inflation hedge, which allows retirement income to rise over time. Bonds have earned the 4 to 5% and provide a reliable income, yet it hasn't significantly risen over time with inflation. So we need both of those pieces within your portfolio to, again, provide you the rising and reliable income over time. And that's where that 4% withdrawal rate comes into play. So if we have, again, a blended average of about 7%, if we have a 4% withdrawal rate, and we still leave about 3% in with inflation, what that allows in this type of portfolio allows 10 years, which is even more significant than a Great Depression type scenario, to where you would be able to adhere to Rule 1A of investing, which is buy low and sell high. As is true in many other areas of life, the most important thing you can have as an investor is someone to stand with you during difficult times. And Michael and I, Caroline and Kathy, are very, very convicted by this point. This chart shows how the average investor has performed during the last 20 years of market activity. The 2000s were very poor from a performance standpoint, and many of you will remember some of the history in the headlines surrounding that time. We had the mortgage crisis, the tech bubble. We could go on and on and on. Yet the 2010s were very, very good. As you can see, though, the average investor has returned approximately 1/3 of the average investment. How could this be possible? The problem is not the quality of the portfolio or the investments, it's the quality of the investor. And that's what we're very, very passionate about, is making our clients not necessarily picking better investments, because in reality, that's the easy part of our job. We want you guys to be better investors. So this is a great study from Vanguard that seeks to quantify the value provided by the best wealth management practices. Notice that while there is some value related to minimizing investment expenses and rebalancing a portfolio intentionally, which are very important, most of the value comes from behavioral coaching. That's why we spend so much time and energy helping you make smart investment decisions and spend time doing things like this webinar. The items below, like asset allocation and spending strategy, are also very important. But if we don't get the investor piece right, then we can't do anything right. You know, we spend a lot of time with our clients on trying to minimize your investment and really your overall tax burden. Well, if you have a portfolio earning 6%, saving taxes on the 6% growth is very important. While if you're only earning 2%, like the average investor in that previous chart, saving taxes in that type of scenario are virtually inconsequential.
Okay, so why else has the market gone up so much since March 23rd? You know, there's one aspect of investing that we've always talked about. However, I've never felt like we had a really good way to actually explain it in understandable terms until now. And that's inflation and the power it has to absolutely wreck your financial plan. You know, there's a saying out there that I've heard that applies to investing. It's not the bus you see coming that hits you. It's the bus you don't see coming that hits you. The bus you do see coming, the bus everybody worries about, is market volatility. But the bus that nobody sees coming is inflation. So it's important to understand how it can wreck your financial plan, but most importantly, what can you do to protect yourself against inflation? There's a saying in our industry, don't fight the Fed. I wanted you to see this chart from what happened with inflation after World War II. So let's take a look at this. Like, as we said before, we can learn more from history than headlines. The Second World War was so expensive that our country actually had more debt than it does now. Take a look at the right-hand column, and I'll move my cursor over here. The right-hand column is the ratio of our government's debt to GDP. GDP is a measure of how productive our country is. So think of it as a debt-to-income ratio for a person. If the federal government was a person in today making, say, $100,000 per year, then after World War II, but in using today's dollars, it had total debt of just a little over $100,000. So these days, if you just imagine a person that had $100,000 income and a $100,000 mortgage, we really wouldn't think that much about it. But notice most of all how much that debt went down here and here. You see those pink dots? The debt went down as the blue line went up here and here. The blue line is inflation. So what's the correlation between our debt to GDP ratio going down and inflation going up? I'll explain how this works. Let's say all you had in the entire world was 100 Cokes and $100. Nothing else existed. That was it. Well, let's just do a little math. 100 Cokes divided by $100 is, each Coke is worth $1. Well, let's say you add $5. So now you have 100 Cokes and $105. Okay? Well, do the math. Each Coke has to be worth $1.05. Inflation increased 5% because money was added to the economy. That's essentially what the federal government did after World War II. That's what they're doing right now. They have a variety of ways they can stimulate the economy. It's basically called printing money because it adds money to the financial system, right? They're not actually printing more money. They are moving more money. They're creating more money. It has nothing to do with how many actual hard dollars. So the price of Coke in this example went up 5% because more money was added to the financial system. So hang with me here. Here's why the federal government likes inflation, okay? If inflation goes up, incomes go up, okay? Now, as incomes go up, taxes go up. Because what are taxes based on for the most part? At the federal level, taxes are mostly based on incomes. And as taxes go up, the government has more money. This is how our country paid down our debt after World War II. And so you can kind of think of it in simple terms. Guys, this strategy is older than we are. The federal government has used it before, and they'll use it again. They used it after 2008. They're using it now. And this is why you need to know about it. How does inflation affect our portfolios? The answer is significantly. You know, I love it. Well, I love it, hate it when people say they lost money in the stock market, because in some ways that's impossible. As we talk about all the time, the market has always reached all-time highs. The last one was February 19th. We're a few percentage points away from that right now. So it has experienced declines that are only temporary. So if you lost money in the stock market, then you either sold at the wrong time or you are simply not invested in the diversified stock market. Only one of those can be true. But let's take a look at bonds and cash. While they can serve a very worthwhile purpose in your portfolio, you can experience permanent losses in these asset classes. And nobody thinks that way. Nobody worries about their safe cash and bonds having permanent losses. This is the bus that can hit you if you're not careful. It in fact happens all the time, and no one ever talks about it. You never hear about it on the news, that inflation being greater than the return of bonds and cash can really hurt you. So let's take a look at this. Let's just do the math. Stocks have returned 10% over the long run. Inflation's 3%, let's say, so your real return after inflation is 7%. Bonds, let's say going forward, they return about 3%. Let's say inflation is 3%, so we have a 0% real return. We have 0% increase in the actual purchasing power of our dollars in this asset class. And then cash, even though cash is very important, we're not saying you should not have any bonds and cash in your portfolio. We're just saying this is what you have to be careful about. If cash earns 1%, which it's not quite doing that right now, and inflation is 3%, then your real return on cash, you're actually losing 2%. Let me see if I can explain one thing. During this period, inflation, guys, was greater than the interest rate on their war bonds. So you had millions of Americans that were technically thought they were supporting the war. What they were really doing is they were supporting our government to pay for the war. Because if you're going to earn 2% on your war bond and inflation is 4%, then you just lost 2% permanently. And I think that's important for investors to understand. The irony here is, what are investors tempted to do during a crisis? Well, they're tempted to dump the only asset class that has a significant real return after inflation. This is the only asset class that has the ability to protect them from the inflation that's inevitable. It's as if, guys, the federal government, through its actions, is telling every investor to hold on to their well-constructed, diversified stock portfolio, if that's what they have, as they kick the toughest part of the financial crisis down the road a little bit, so they can soften the impact for everyone, and we can adjust as a collective economy. But investors are often unwilling to listen. So let's conclude. Number one, the market is always a leading indicator, not a lagging indicator. Guys, it'd be great, the market tells you what is going to happen in the economy. It would be great if there was some other indicator that would tell us what would happen in the market, but it doesn't exist. The market can go up when there's less bad news. It does not necessarily need good news to improve. Very important to remember. Number two, history will always be more important than headlines. You guys have heard the quote from Harry Truman that we love. The only new thing out there in the world is the history you haven't yet read about. Number three, investors need to understand the difference between a short-term bear market and a long-term bear market. Short-term bear markets, like what we're seeing now, occur several times inside of a long-term bull market. This long-term bull market started in 2009. It might last till 2030, 2035. Nobody really knows. But we'll have more short-term bear markets like this inside of this long-term bull market. Number four, we often cannot ignore fear. I'd say we probably can never ignore fear, but we also at times can't get rid of it. Sometimes our only option, like Tony Robbins said, is to dance with it. Number five, you can be prepared for a Great Depression by allocating stock, bonds, and cash appropriately. The main point there, guys, is that we don't think another Great Depression is happening, but the good news is that in our example, you could still have 60% of your portfolio allocated to growth assets to protect you against inflation, to capture a good bit of the market's return, and yet you're still prepared for a Great Depression with an allocation like that. We're not saying everybody should have that. We customize that for every investor. But that's the wonderful thing about a portfolio designed like that is it allows you to take advantage of growth, but also be protected from volatility. Number 6, the irony of each crisis, each financial crisis, is that investors are always tempted to sell the one part of their portfolio that protects against the inflationary measures taken by the federal government. Number 7, as is true in probably all areas of life, the most important thing you sometimes can have as an investor is someone to stand with you during difficult times, and that's what we want to do. Number 8, compared to bonds and cash, only stocks have had a significant real investment return above inflation. They all serve a purpose, but it's important to understand the purpose they serve. As we like to say sometimes, turn off the TV and turn on some music. There's a lot of crazy things that you can learn about in the news every day. Much of it is not even financially related to the markets. It makes me think of this quote from Winston Churchill: "Democracy is the worst form of government known to man, except for all the others." So regardless of what you think about the issues facing our country these days, we certainly have a lot of them. Let's remember that this is the best form of government out there. And we've made it this far. We've made it through crises, both financial, both social crises, and we'll make it through the challenges that we face now. As another author, one of my favorites, said, "It's a gnarly time to be alive." We appreciate you guys very much. Thank you as always for listening. Thank you for trying to stay informed. And thank you most of all for allowing us to serve you. We'll be in the office. If you have any questions about the material we presented or how anything going on in the market right now affects your portfolio or your financial plan, we're always here to help. So email us, call us, and we'll talk soon.